All right, welcome everyone to AIIC's uh, online webinar. We got some great attendees today. Thank you all, by the way, for your individual messages on some of the questions and topics you wanted to go over today, so that we can address some of the concerns and outline questions out there. We have some special guests here today again. Kevin Wright actually will be joining. He just landed. He'll be joining just a few minutes late, but we can begin without him, and he'll tag along. First off, thank you, Niral and Phuong from KLDP, for joining us here today. And
Yeah,
of course, Aaron Goforth is here from Wright Goforth Capital. Appreciate you three being here.
thank you,
And
Vikram.
yep, definitely. Um, Hopefully, you guys got some dinner. We have a lot of questions, so this may carry on a little bit longer than our traditional 1 hour length, but I'll try and be as precise as possible. So, um, some key subjects that we're going to talk about. A lot of the questions have come about regarding source of funds. Self-directed IRAs, some do's and don'ts, partial funding, and then some risks, spotting some deals and risks, more for Aaron and Kevin, who do the business economic analysis reports and feasibility studies and a lot of the business plans for EB-5 projects out there. So. I'll start off just by talking a little bit about AIIC Group. Again, we're known as the American Investment Immigration Company. At AIIC, we focus on, EB-5 investments are engineered for security. We don't do, dozens of projects a year or hundreds overall. We've done 21 successful projects. We're focused on three main things. Number one, how to get your green cards. Number two, how to get your hard-earned money back. And number thrve, we're very risk-aware, compliance-driven, and of course, investor-focused. We've done over 1,600 immigrant families successfully. Everybody gets their green cards. Everyone gets their money back. Recently, by the way, thank you, Niral and Phuong, on our most recent I-956F approval for the Amangani Rural Project. So that has really taken off, and appreciate all your hard work in getting that through for us, by the way. At AIIC, and through its principals, predominantly Kevin Wright, we've created over 1/3 of all regional centers. Of course, all our projects go with our regional centers as well. But over 230 regional centers out there have been created by the AIIC group and its principals behind there. So I'm going to give a couple introductions, who's on our panel here today, specifically, and of course, part of the AIIC group. So first and foremost, we have Kevin Wright of Wright Johnson and Wright Goforth Consulting. Again, Kevin and Aaron do business plans, feasibility studies, creation of regional centers for all, regional, tons of regional centers out there, not only ours, but other big names out there as well that I'm sure many of you have heard of. Two world famous economists have been doing EB-5 for decades and very, very successful in the industry and focused on, minimizing the risks out there. I myself am the president and CEO of AVG Group and a managing member of AIIC Group, have been doing this for over 15 years myself and focused a lot on large real estate investments and EB-5 type capital projects. And then, of course, our special guest here today, before we dig into the questions, let's talk a little bit about the firm itself. So I've known Niral and Phuong for quite some time. Um, in fact, I think one of the first times, Niral, if that's correct, when we had gone to India for some EB-5 seminars, we met over there for the first time, way back when. But KLDP's global EB-5 practice, they've been extensive experience in, all different sides of the EB-5 process. So not just the regional centers, but also developers, investors. So kind of working from all different angles there. They've advised over 5,000 investor petitions, done well over $3 billion in EB-5 financing deals. Whether they be in the hospitality industry, public infrastructure projects, HUA, rural projects, both pre-RIA and post-RIA. And what's quite nice and very unique is, every single EB-5 offering or project that KLDP has ever, touched on or represented has received approval from the USCIS. So we've actually done over 50 projects together through AIIC over the past 12 years or so. And of course, we are very thankful they are joining us here today. So again, thank you, Phuong and Niral, for your attendance today.
Thank you.
Thank you.
So we're going to start off with some questions, and I believe just from a logistic standpoint, or housekeeping, there will be some questions and answer sheet up there that will pop up here shortly if anyone has any open questions. Aaron, do we have that all squared away? Do you know?
Yeah, no, it's open.
Okay. Well, sounds good. The first question is actually for Phuong over here. Let's talk a little bit about the source of funds landscape. A lot of people have been asking, are personal loans okay for EB-5? Do they need to be secured against collateral, as an example? So just maybe touch a little bit about that, please.
Yeah, no, and obviously, Vikram and Aaron, thank you guys for hosting this event, for having me and Neural here. We see the questions, we see the questions on WhatsApp, we see it through emails, we get asked questions on other people's webinars, so we understand that these are topics that commonly pop up and everything else. I think part of it that's interesting, and Neural will say this too, is that, what we've always said is the actual law on EB-5 doesn't really change all that much. What changes though is the agency's focus, their priorities, the red flag issues that they go through. Um, what we see now is an agency that I think is much more RFE driven, RFE happy. We definitely have to guard against some of those issues. I think part of it is, from what we understand, there's a real push to get rid of a lot of like career adjudicators. So due to Doge, due to Elon and everything else, we have a new crop of adjudicators that's much more new, right? And so the kind of RFEs we're seeing reflects that kind of thing. Um, a lot of our old strategies, a lot of old things that we do will still work. We're not terribly concerned about it. We just have to be more careful with documenting it. Source of funds wise, for loans, personal loans have always been okay. I think the real focus, what we're seeing nowadays, is USCIS is really focusing on who exactly is the lender. There's really two buckets that we look at. One is if it's a lender that's, say, a US bank or a credit card institution or something along those lines. Generally speaking, they're much more amenable to thinking that's okay. The underlying loan agreement still has to you still have to make sure that there's no restrictions on using it for investments or securities, but otherwise it's fine. If you're using a non-bank lender, and when I say non-bank lender, the easiest way to think about this is your friends and family. Um, what we always tell people is, if you're taking a gift or loan from friends and family, make sure that they're comfortable providing their financial documents first. We're talking about, so because the thing is, your friends and family might love you, they might be willing to give you a gift or a loan, but they might not be willing to give you their tax returns, their W-2 statements, their bank statements. And I think it's best to have that conversation with them first before you ever do it.
Got it. Got it. Thanks, Phuong. A follow-up question to that. What about is it possible to use IRAs and Roth IRAs without withdrawing the amount? So I think it's essentially the question further asked to take a loan against your IRA or Roth IRA.
Neural, you want to do that one?
Yeah. Oh, yeah. And just real quick before we do get to that, one thing as we talk about how source of funds has changed, especially with this admin, one of the biggest things that's really come up recently is the issue of commingled funds. This wasn't so much of an issue beforehand. USCIS previously was applying, I would say, a preponderance of the evidence standard where it's just more likely than not that your SOF was what you said it was. Recently, we've seen USCIS really coming and attacking bank statements. They want complete bank statements for every single month for however long period of time. And they are reviewing every single deposit that goes in there. I don't know that we've seen some crazy RFEs where they're even asking about a number of Zelle transactions, and things like that. So I think, when we go about preparing source of funds, something that you just maybe take us like just a couple of weeks to do is now taking a little bit of time because we're also having to pour through numerous and volume of bank statements and making sure that these deposits are accounted for, making sure accounts aren't commingled. And there are definitely strategies around that, such as opening up new accounts with no transactional history. But these are definitely things that applicants need to be aware of as before they even start their source of funds process. So anyone who's looking to start EB-5 or do EB-5 in a couple of months, take a look at your accounts, see where your funds are consolidated or where they're coming in from, and discuss with an attorney on what you can do to guard against that.
Got it. Got it. Okay, that makes sense. And then the subject regarding a particular question on taking
Oh,
loans
yeah,
against
the
IRAs and
SDRA
Roth
Oh,
part.
IRAs. Yeah.
yeah, you could take loans, you can roll over your IRAs and things like that. One of the most common ones that people are using is they're rolling over their previous 401k through a self-directed IRA, which is, it's a permissible source of funds. It's something that has been approved and it's something that will continue to get approved.
Got it.
Um,
And lots of people are, concerned about RFEs, and there's some, potential talks about or issues surrounding SDIRAs, to fund EB-5. What can you say about this? I know that you guys were one of the first, actually, is my understanding, to do SDIRA sources and have been successful at it, but love to hear from you guys on that.
yeah. Um, And really, when again, I always tell this story because I think a lot of times people think that Niral and I just sit around, thinking of these crazy financial methods for to use for EB-5. That's not it. Like what we're looking at is like, look, we are investor facing as much as we are project facing. And so when we sit down with you guys, I've always said source of funds is like a puzzle, and we just need to know what puzzle pieces we're working with. Everyone here, including the people who are speaking right now, I think we all have quite a bit of money tied up in our retirement account. So really, whether retirement funds in general are approvable. If it's from your 401k account, right? There's just things that you guys need to know. Like if it's from a 401k account, both people can use it, but you're capped at taking loans. That's all. If you are trying to use the bulk of it, you have to roll it over to an SDRA, like Noral is saying. And the biggest benefit to everyone here would be that there's no cap in how much you can use, right? If you have a Roth IRA, you have a traditional IRA, you have an old 401k to roll over, all that stuff you guys can use. Now, we're well aware of the recent spate of nor the RFE issues surrounding SDIRAs. And I think what's funny is two things. One is if anyone has actually read through the language of these nodes. So our general thinking is this. It's no secret that USCS is probably using LLMs, just like a lot of you guys here, to analyze legal documents. And you can imagine what query they're running. Um, what does an SDRA custodian need to do in order to be legit, for them to be lawful? Because there's no other logical explanation of why they're citing just esoteric like RS codes or whatever else. But the short answer is this. In the noise that we've seen, and not to discuss investor-specific issues, but in the noise that we've seen, they don't question the use of custodial accounts, such as an SDRA. They don't question that that's lawful. What they're actually questioning is whether a custodian is licensed and regulated. And the funny thing is, if you actually, my question to all our investors or to people who ask us this is, have any of you guys actually bothered to contact the SDRA custodian? Because if you did, they will give you all the information you're looking for. Um, I speak for both Niral and I. We are perfectly okay with SDRAs. We are perfectly okay with you guys using 401k loans. They're all approvable. We have to just do some basic background information, some basic licensing stuff, but we're not worried about it being approved.
Do you know if there's a minimum amount to funding, to open up an SDIRA account, or is there like a
I don't think there's
recommended
a
minimum?
I don't think there's a minimum or a maximum amount. I mean, we've seen people use however much, so it doesn't matter how much comes from your SDRA.
Okay. And there's because obviously there's a lot of fees behind opening up an SDRA. Is there a recommended? I guess it will depend on each individual investor's situation predominantly, but
If it's over
um,
50,
yeah,
I mean, otherwise it's not worth doing it for like 10 or
Right.
$20,000, right? And I think I want people to look at so this falls into the whole bucket of it's not whether you can do it or not, it's whether it makes sense. So I think it's the same question we have with when people are like, hey, should I open up a regional center? Should I form a regional center? You can do it, but does it make any financial sense for you? So the real thing is, if you're doing SDRA, I think it generally only makes sense if you have over 50 or $60,000, or you have a large amount that you want to use for EB-5, right? All tax advantage, you won't have it'll stay tax advantage. And I think the other big benefit in the future is after the regional center or the project pays you back in the future, well, now it's all your SDRA money to play with, right? You can use that and invest in a tax advantage account, no different than any other IRA, except you have a bigger menu of options now. So, yeah.
okay, well that makes sense. Another question that I've come across quite a bit by investors even some of our projects. Some of them want a partial fund, right? What are your thoughts about, from the legal aspect, partial funding? Is there a certain period of time in which, if you're filing your 526E and then, you fund within a 6 month gap the balance of it, or 9 months, like, how does that impact processing and your filings?
I mean, for us, and historically, partial funding has always been allowed. And then through the RAA, USCIS sort of made that explicit in their Form I-526E because they ask you to put a funding schedule where you can put down exactly how much you're investing now and how much you're investing in the future. So partial investments completely allowed, as long as you have what they say is the irrevocable commitment to complete that funding, which is that you have the funds to go through with EB-5. You have a specific date that you're going to fund by, and as long as you follow through with that, your I-526E should be approved. In terms of timeline, I think it really depends on the project. Depends on where the project is with the 956F. It depends on how quickly I-526E approvals are coming in. I would say, probably in a rural deal, um, maybe 4 to 6 months. In an HUA, probably about 8 to 10 months you could get away with. At the same time, investors should be prepared that, just because, if USCIS picks up your application early, they can always issue an RFE asking for, asking for the balance. And so they need to be prepared to fund earlier if they have to.
Got it. Got it. Okay. And maybe as a follow-up to that, what about changing your source of funds after initially filing your I-526C? Would that cause an RFE? Is that an automatic NOID? How do you know?
Fung will jump in a second. But I will
Yeah.
say this can go one of two ways. I think USCIS doesn't like it. We're of the opinion that you should be able to do it, and I think we have pretty strong backing to show that you should be able to do it, provided that certain conditions are met, such as having the irrevocable commitment to invest from the beginning and having the assets to liquidate.
Mhm. I mean, the
Uh,
stock market fluctuates up and down, and if people are using their stocks and they want to change it to other sorts, they should be able to
Exactly.
do so, right?
Right.
Yeah.
yeah. I was
But
actually
maybe you'll
hoping to
talk a little bit
give
about
Niral
some
all
do's and
the
don'ts. Yeah, go ahead. Sorry.
no, I was actually hoping to give Niral all the hard questions so I could just sit here. But no, I mean it depends how it is, right? I think part of it is we're seeing so there are things unwritten that people that the service will never say, you know. So if you're looking for positive affirmation, positive messages from the service that A or B is okay or not okay, you will hardly ever get it, right? So it's weird because we get tricklings of how they are from these various RFEs, NORs, or whatever else. So I think part of it is um there's very strong legal arguments for why quote unquote partial investments are okay. And you do a deep dive. The actual explanation is not a partial investment. It's really you're showing that you are actively in the process of investing, that you have an irrevocable commitment to invest. And this is important, and this is an important distinction because it explains why you are allowed to theoretically change your source of funds later on, right? The actual so one thing that we've kind of discussed internally is who should be the person, what should be the entity to decide someone is actively in the process of investing. You look at these recent RFEs or decisions from USCS, it seems like they're saying that it should be USCS, but we don't think that's correct. The entity that should be deciding this is the issuer, right? Because it's the issuer who decides the minimum investment amount. It's the issuer that decides your anticipated funding deadline. And your real commitment is that side letter, right? It's basically a promissory note. You're putting down a down payment in essence with a promise to pay the remaining amount. Otherwise, there's penalties and fees and everything else you have to deal with. So with that in mind, if you're investing on a promissory note, there's not a single promissory note that I'm aware of, and Kevin and Aaron, maybe you guys know, but nobody asks when you have a promissory note where your funds are coming from. All you care is whether you can pay the promissory note. So exactly to Vikram's point, if in the future, for example, if I tell you at my 526E filing that $100,000 is going to come from my HELOC, $100,000 is going to come from my stocks, but 6 months later, the stock market has lost 20%. Am I not allowed to borrow more money from my HELOC if I want to, or decide to not sell the loss? It's nonsensical, you know. The only asset that you would have to invest that stays static is cash. Everything else that you have is the value goes up and down. So to change the amounts, to change the composition, I think should be okay because your actual intent should always be the same.
And
Mhm.
then also, this whole when they argue that you didn't have a commitment to invest, don't forget this is still an immigration program. No one is doing EB-5 to make money. You're doing this for the immigration benefits. So everyone going into this, everyone doing a partial knows that if I don't complete my investment, then there go all my immigration benefits. So I think, it's kind of a BS argument on USCIS's end, but there are definitely strong arguments to back it up.
Mhm. And before we shift subjects from source of funds, there's a couple questions here. I know the answers, but I'm sure they want to hear from the expert attorneys. So, uh, you know, have loans from India been successfully used for source of funds? And if so, and I think I'll elaborate on this question for this person here. I think it depends whether it's a loan for your own property or if it's a parent's property. But basically, he or she is asking whether adding a layer as a gift, maybe from your parents in between, does it help? So is it better to get that gift from the parent or the loan from the property if it is a property owned by the parent, if that makes sense?
Well, I think, if it's a immediate family member, I think gifts are sort of the way to go. With loans, again, USCIS allows loans, so not an issue there. They've just got to make sure that they're doing everything right by FEMA and the RBI in India and making sure that the loan is allowed and to be taken out of the country. That's the only thing. So they would need to check with their advisors, with their bankers in India, and making sure that they're doing everything correctly.
Yeah, for FEMA standards, and then of course RBI laws, and the amount of remittance. That's what you're referring to, Nero.
Yeah.
Okay. And a couple more questions here regarding source of funds. well, in general, with EB-5 investments, are they considered as if you're investing in a security? That is because
Yeah.
Sophie provides personal loans should not be invested in securities.
This is not even really debatable at this point. And if you, because I've seen, I don't know why, but like I've seen a couple inquiries lately or discussions about how EB5 may not be a security. It's nonsense. To me, this is not even debatable, right? EB5 is clearly a security. The SEC has regulated EB-5. When you file 956Fs, one of the things they will ask you is, have you filed Form D to register the sale of securities, right? So it's clear security. The real question of what you're getting here is if you are taking out a loan, whether it's a HELOC, whether it's a margin loan, whether it's a securities-backed line of credit or whatever else, you need to read the fine print. You or your attorney, or both, right? Because part of that is you need to make sure that there's no restrictions on the loan agreement on using it to invest in securities. Sometimes you will see if you're taking a loan that they earmark it for a very specific purpose, or they have restrictions like you can't use it for real estate, you can't use it for securities, you can't use it for investments. If it says that, then you probably can't use it for EB5. But again, this is a question you check with your attorneys first.
Okay. And can you use, I believe you can, but use 401k from previous employers for filing EB-5? I mean, ultimately, it is your own 401k, so I assume the answer is yes. But more importantly, what documentation is sufficient for it? Because it's your previous employer.
Depends
It's
on how
pretty.
you ask. Go ahead and Hunter.
Yeah, I was going to say it's pretty straightforward using your previous 401k. I mean, especially when you're rolling it over through an SDIRA. You know, you already have to include your 7 years of tax returns, your W-2 income statements, and evidence that you've been previously employed anyways. So it's just a matter of including those 401k statements and then the rollover documents.
Got it. Got it. I see that Kevin has joined us as well. Kevin, I know you're much taller than that. Why do you always seem very short on the
Not that tall. Not that tall.
So welcome, Kevin. Of
Mhm.
course, we weren't here at the beginning. Thank you for joining us. Um, I'll shift a little bit towards some of the project-based questions, and then we can go back towards some more of the legal questions as well. Um, Maybe we'll start off from this. Kevin, having been a consultant, on so many projects and creating over 230 regional centers out there, how do you, from an investor perspective, identify risks or red flags in EB-5 projects? What are like the do's and don'ts that you always look for in an EB-5 project?
Uh, well, I mean, I would say there's a lot of answers to that question, right? But as consultants, what we're trying to do is to help design projects that are going to be basically in the 90th percentile. If you can get into the 90th percentile, then there's only a good handful of projects at a given time that can compete and be the best type projects for what investors are looking for, which is just two things. How are you going to basically guarantee me my money back, and how are you going to guarantee me a green card? And obviously, you can't do 100%, but how do you get as close as possible, right? And so, there are a variety of ways to do that, but typically, I mean, your first thing is you got to eliminate risk. So, how are you going to guarantee that whatever this project is that you're investing in is going to be completed? Are the appropriate guarantees in there for completion guarantees by developers? Do the developers have enough money behind them or wherewithal? Do they have bridge financing if the project's in a second position, for example? If it's not, do they have other ways to cover the difference if the EB-5 raise falls short? What are all of these different things? Because like if you don't complete the project, you're not going to complete the jobs. So that's the first thing you're looking for. And then, obviously you're looking for people that have a long track record, brands associated with it that are clearly know what they're doing. I mean, there is a difference between a hotel, for example, with a strong brand behind it that has a strong reservation system and a history of operating, and somebody's boutique hotel that has never operated before and is, unbranded, or, at least not attached to a reservation system. You got to look at the feasibility of the projects, right? So do the projects have real feasibility studies? To me, is a big difference. You're not required to have a feasibility study by the USCIS, but having some sort of, you can come up with your own third-party verification to get your project approved by the USCIS. Like in construction, for example, you could get a subscription to RS Means, and that'll give you some averages, and that'll back up your numbers that you come up with as a developer. But having a third-party company that is not aligned with the developer to come up with those numbers and to verify everything, that's kind of the gold standard to make sure that you have that in place as a minimum. And then, safety again, like, hey, there is a difference between mezzanine debt and preferred equity. They may act in the same way, but there is a difference. So, making sure that you understand that and the risks associated with that. There's a difference between first position and second position, or third position in some cases. Equity investments are clearly radically more, carry more risk than a debt position. So understanding how that works. And then, job creation, right? So you want to have a heavy load of your jobs to be taken care of under a construction scenario where jobs are going to be created by spending money. And so you're not dependent on a business and how well it operates. You've got various guarantees along the way. And then I guess, more nowadays is people are really focused on repayment. How am I going to get repaid in what period of time, right? And because everybody is now switched from what used to be 5 + 1 + 1 to 3 plus something. It might be 3 + 1 + 1. It may be 3 + 1 + 1 + 1 + 1 + 1 + 12. It might be, anywhere in between, right? So does the story make sense, and does that fit with you in terms of, what you're looking for in an investment, right? So there are projects where they're longer return periods, but are much safer, in my opinion, when you're looking at them. And there are other projects that, okay, they have a little bit more risk, but at the same time, they could have a strong chance of repaying you back in a much shorter period of time. And so looking at that risk versus reward, well, if somebody's going to repay your money in 4 years, or they're going to pay your money in 7 years, well, what's the value of that money to you if you had it back quicker? And how much, risk are you going to look at for having that money back that much faster? So,
Kevin,
as an investor, how would you go and like what questions should investors should be asking? I mean, they're not necessarily expert economists like you and Aaron out here, right? Like what should they be looking for?
I have two questions that go off of that because it's very common, and because I know Aaron and Kevin, in addition to your consulting work, you guys underwrite projects, right? So, a lot of we're not even talking about EB-5 senior loans because that's more straightforward. But if someone is comparing, they are interested in EB-5 project, but one is mezz debt, right? One is a mezz loan, and one is preferred equity. What's two factors in each that you think they should be aware of?
Yeah, I mean, I think that, for example, preferred equity is still equity, and that's still, it's not as strong as mezz debt. Mezz debt has actual teeth that have lending rights. Preferred equity does not. They both act in the same way. There's a specific return rate and so forth, and a specific end date, but it doesn't have the same amount of teeth to it. And then you also got to look at like first versus second and so forth, understanding the intercreditor agreements between them. So in the case of mezz debt and a senior lender, there's always going to be an intercreditor agreement. And the first thing I'm always looking for is like, what are the terms and do they line up? Because what happens if you have a senior lender who's at a 7-year term and you have an EB-5 project that's telling you that they're going to repay your money in 3 years, but there's, 4 1-year extensions to it. Well, is there a real chance you're going to get paid back in 3? Well, I don't know. It depends on if that intercreditor agreement says that you can't repay any other debt other than unless you retire the senior first, and the senior is at 7 and you're at 3. Well, that doesn't make any sense. And so you got to look at it that you're at 7 years because they got to refinance at the same time. And so you look at that, and then, there's obviously how are they going to repay you, right? Like, if you're at a 3+1+1 on new construction, and the new construction is at, 24 to 30 months, and you're at a project, depending on what kind of project it is, but if it's a business, like an apartment building, a hotel, something like that, well, you got to be able to prove stabilization. And how are you going to get to stabilization in 3 years if it took 2.5 years to build the project? And so, does that make sense? In a lot of projects, there's other ways to get around that. You may be doing a hospitality project that also is selling parcels of land as houses along the side, and maybe that's the repayment. And so now you have a different way to look at your risk. It's like, well, do I believe that they'll be able to sell these parcels of land in 3 years? Or is the project existing and renovating? Is it ground up? All of these things you kind of have to look at, and just, it really comes back to common sense. Does this make sense that somebody could repay me in the period of time that they're saying?
Yeah, I agree. Like it's, to be a little bit more basic for me is like first position is great because you have collateral, but you are the person that's underwriting the project. Where if EB-5 is in a second position and preferred in mezzanine position, you know that there's been two parties that have done due diligence and underwritten the project. So there's advantages and risks to both. But do you want, to ensure you have good collateral in a first position, or do you like the safety of being behind a senior lender or another financial institution that also underwrote the project?
Mhm.
Mhm.
One of the questions here by an investor is, what exactly is NES debt? And I'm not sure if they're talking about mezzanine
Yeah.
loan or mezzanine debt, or but
Yep.
NES debt, yeah.
Kevin?
I mean, that's basically mezz debt is a second position lending instrument. So it is a loan versus a preferred equity where you're investing in equity of the project that comes after all debt, and it carries a very specific rate of return, but does not have the same type of rights that mezzanine debt would.
Got it. All right, so we have some further questions regarding just concurrent filing and back from a legal perspective here, and predominantly around job creation. So there's a lot of PPMs out there. It seems like the majority are on a FIFO-based system based upon, filing of, concurrently filing your 485 on a jobs allocation or job creation standpoint, first in, first out. Some projects out there have, based upon I-526E, receipt. Niral, maybe you could talk a little bit about how does job creation work for an investor, like with respect to, these different terms they should be looking for in a PPM, or how does that make a difference, I guess?
I mean, I think the first thing to understand is that job creation, and I'm talking about, in the regional center area, is that you're not counting people working at a job site. You're not counting W-2 operational workers. It's entirely based on an economic formula. Basically, the amount of EB-5 money that's spent on a project and used on a project outshoots a number of jobs. And obviously, Aaron and Kevin, they're the experts there. Um, but it's also for that reason that, when Phuong and I, we sort of advise, people come to us and they ask, what makes up a good EB-5 project? How do I guard against, how do I make sure that there's enough jobs created? A few sort of things that we look for in a project is making sure that these projects are fully financed, which means that they have the sufficient funding to actually go through with constructing and completing the project. We always want to make sure these projects are already under construction when an investor is going into it, so you can actually see that the job creation is happening. And some of these projects will also have completion guarantees where the developer is contractually obligated to complete the project as per the business plan. So that also gives you a sense of the job creation, the comfort that that's going to be met as well. And you always want to look for if it's a good EB-5 project, job creation is the least controversial part of it. Any good EB-5 project will already create more than sufficient jobs that are needed. And so you don't even have to worry about when are the jobs going to be allocated to me? Is it going to be on 526E approval? Is it going to be on a first in, first out approval? Because chances are, by the time you've even gotten halfway through your conditional green card, this project will have created more than enough jobs for you anyways.
But how do you know what's considered a good? I mean, I'm new to EB-5. Let's just say what's considered a good project from a job creation or not a good project. I mean,
Uh,
people, the ranges out there from I've heard, hey, you have 10% surplus to 30% to 500% surplus. Like, how exactly do I'm new to EB-5. How do I gauge that?
hello, Mr. New to EP5 person. I'll give you a good answer for that one. All right. So look. We always talk about, and a lot of you guys kind of like hit on it as well. There's a difference between reality and there's like marketing fluff, right? Or marketing like fluster. Um, Job creation buffer, job first in, first out, job allocation strategies are all nice and everything else, but realize it only really matters when you have a job forecast, right? So Niral hit on it earlier so when we, so we do projects all the time. We do a bunch of them with Aaron and Kevin and everything else. But for us, what we're looking at is not actually the job allocation, the job buffer and everything else. What we're looking at is actually the easiest, it only matters if the jobs are not there. What you should really be looking for, in the easiest way to look at it, is look for a project that's already under construction. Look for a project that's already creating jobs, because there will reach a certain point in that process where the project has created enough jobs to cover everybody. It doesn't matter where you are in line, right? And so that ideally is where you want to be. You should never be in a situation where come to 829, you have no idea whether your 829 will be approved or not. Our personal preference as a firm is you invest in a project where either on day one, you already know that the project has created enough jobs to cover your 829, or will do so within 6 months to a year. And you can calculate that, as Aaron will tell you, because the funniest thing is, if you look at the economic analysis for these job creation formulas, it's basically a multiplication table, right? For every $1 million spent on hard costs, it creates, say, 10 or 12 jobs or so. So what you actually want, and it goes hand in hand with what has this project done so far. If they're under construction, literally every single day they are creating jobs. So month by month, we can track exactly how many jobs has been created. And for us, once we know where it is, once we know that it's creating enough jobs, then we're in the green zone. We're good.
Mhm.
So in other words, pick a project ideally that's created all the jobs for you.
In advance that all the jobs are already created. That's what you're saying. Yeah.
Yes.
And
Yes.
and it's also important, right? I mean, you'll already have the econ report that you can show to each of your investors anyways. Don't forget, each of these projects also go through an annual audit. And during that annual audit, they have to report to USCIS their most up-to-date job numbers as well. So you'll get that on an annual basis. A lot of these projects will also give you quarterly updates on their project and construction progression and things like that. So a good project will keep you up to date at all times.
Fair enough. Fair enough. Um, this one's back for Aaron actually here. Uh, why do we say that a mezzanine loan has a higher value in comparison to an equity-based position? With equity, the regional center or the limited partnership might have some say in the project versus a mezz loan where you are just a silent investor. I'm not sure if that's always the case, but I'll let you answer that question, please.
Yeah, I think the primary objective of most EB-5 investors are to get their green card and get their capital returned. So the project developers that want to use EB-5 capital are well-polished, well-put-together projects. So they're not looking for equity partners or providing equity returns. So if you want an equity return and a more say in the project, inherently you're going to be taking on more risk. So if your objective is to get your capital returned and ensure that your jobs are created and you have a successful outcome for your green card, I think that's why folks are saying that first position, second position, EB-5 as a mezz position is more likely to get you to that outcome than having an equity investment where you have a bigger say in the project and likely a higher return. If you look at a $170 million deal, the first investors that come in as equity, they're doing like pre-development expenses, right? They're paying for architect. They might be investing in the deal before it's even shovel ready or entitled. Where if you come in as a LP or as a EB-5 investor into a project that's down the road, a lot of those operational and developmental risks go away, but also the return goes away as well. So,
but don't you also have, and I think Kevin, you were alluding to this before, in certain projects where, let's say, it is a mezz loan, or you're replacing a bridge loan with EB-5 investments, that intercreditor agreement does allow, in certain cases, depending on how it's written, the limited partners of the NCE that's providing the mezz loan, for the EB-5 investors, they do have somewhat of a say in voting if in case there was a default or whatnot.
Well, here's what I'd say about that is that if there's a default in the project, anybody who is the manager of an NCE is going to be put into a position where they have to make a decision. Am I going to default this project? Am I going to try and foreclose on this project? Am I going to do a workout, which is what would be most common in this case is you do some kind of workout with the developer, meaning you got to come to some kind of agreement to settle the issue, to figure out like, okay, do I have to extend this loan for an extra year? Do I not want to do that and just force them into a position where they have to liquidate assets? And generally what's going to happen if you get to that scenario is that the NCE manager is going to have extensive conversations with the developer and really kind of analyze where the project lands. And if I do default them or foreclose on them, can I liquidate their assets in a quick way, and how much money will we get back? But regardless of that, I'm going to go back to the investors and say, hey, listen, this is my opinion. This is what I think we should do. However, everybody needs to vote on this and be on the same team here. And we're all going to go forward with this, because if 80% of you disagree with me, then we have a problem, and that's not going to be helpful. And so before we make any final determination, we really want to have a vote of our members and represent their interests. Now, I will say this, in terms of the difference between the preferred equity and the mezzanine debt, another thing that's important to understand is that imagine that you're in a second position and you're either mezzanine debt or you're preferred equity, right? It seems like it's the same thing because you're getting a set return rate and somewhat else. But imagine that to your first position, if you're the bank and you're preferred equity, the developer doesn't necessarily tell you, oh, by the way, I have 80% of my equity is made up of preferred equity from EB-5 investors. They instead just say, oh, I have 30% of the money as equity. And they don't mention where the equity came from, right? And so now that bank leverages it all up to 70% and they issue you a large loan, but you don't necessarily have recognition from the bank of your investment. Versus a mezzanine debt, you're going to have an intercreditor agreement because it's recognized debt and the bank recognizes your position that's in front of you. And so you have set rules in terms of when these things happen at the end and when they, if they don't work out. And so that's kind of the better position to be in is the mezzanine piece.
I think one thing I want to quickly add here is because it comes up a lot, right? And people are confused because exactly like Kevin said, sometimes you have preferred equity and you have mezz debt, but it's 3 to 4% here, 3 to 4% there. I think the easiest way to think about it is the trade-off is the priority of your return, priority of repayment return versus potential upside, right? And so the basic rule that everyone should remember is all debt needs to be paid off first, whether it's first position, second position, mezz, or whatever else, and all equity comes after that, right? So a common marketing trick that people will tell you is that, look, your preferred equity, I'm the developer. I only get paid after you get paid. Well, yeah, that's true because that's what preferred equity is. That's you don't get a cookie for that. But I think really what you're doing when you're doing EB-5 is I think EB-5 is not designed to make you rich. You want return of capital and everything else. So if you're really risk averse between the two, I think mass debt makes a lot of sense in general, right? But again, it's project by project, but I think this is the simplest way to think about it.
Okay. And what about, is it better to have a larger CapEx based project? Like, is there a certain minimum, whether it's a, $20 million, $30 million, or hundreds of millions of dollars? How does that, from a project base standpoint, or is it more, yeah, oh, let me just pause there.
I think it's kind of a dynamic question because it's not just the size of the CapEx. It's like, what is that CapEx being used for and how does that tie into the overall business model and does it make sense? So if the CapEx and the expenditures are well supported and it's going to create the jobs you want, that's a very important piece. But the second piece is, how are they refinancing this large CapEx project? What is the business model? So while it can be an important component, it's just one component.
Yeah, and I'd just add to that that those numbers can be so skewed around that whether you have a $500 million project or a $50 million project, I think in the end you're worried about repayment. So your total debt to value of the project of all debt versus all value of the project and where you sit in that kind of is more important really than the size, right? Like because you could have the same project, $100 million project with EB-5 in first position at $60 million and it's in first position, or you could be in the same project where there's a bank at 60 million and EB-5 is only 10 million. And so the size there is dramatically different, but in the end, it's where are you in the system? And what you really got to look at is there's 70% total debt to value of a project. And so are you comfortable and believe you're going to be able to get refinancing for that total amount?
Yeah, and I think I'd like to add a little bit to that, Kevin. Don't you think it also matters, let's say it is, how much skin in the game the developer has into it, and if you're a senior position over that developer, and B, who the developer is behind that specific project. If it's a $10 million project, or sorry, a $100 million project, you don't necessarily want a developer worth 30, $40 million. You want them to be substantially much bigger
Yeah.
to be able to, structure that, to be able to weather, COVID or weather type of situations, right?
No, of course. I mean, you got to look at that in just again common sense, right? Like if a developer's worth $20 million and they're doing a project that's a $7 million total project cost, well, that probably makes sense. But if a developer's worth $20 million and they're trying to do their first project and it's 100 million, well, cost overruns happen and they could sign a completion guarantee, but they've got to be able to have some kind of wherewithal to back that up. So I do think like size of your developer versus size of your project kind of goes together, right? Like if you're doing a $200 million project, you better have a developer worth $1 billion. If you're doing a $100 million project, you better have a developer worth several hundred million. If you're doing a $10 million project, well, your developer only needs to be worth a few tens of millions because what you're worried about is they got to be able to complete.
Mm-hmm. No, that's good enough. Next question is actually, I'd like to hear it from, either Phuong or Niral from a legal perspective. Obviously, I'm sure Kevin and Aaron have their perspective as well. But, in your guys' experience, having done EB-5 for so many years, a lot of projects out there get, JLL or HVS to come in third-party projections out there. How often do you see that those projections actually come to fruition? Are they generally a lot of fluff? Is it, can you rely on these type of reports out there? Do they use comparison analysis? Like what based on your experience and the outcome you've seen out of a lot of projects you guys have structured, what is your experience on that?
I'm glad you answered that question because I've been waiting for a question that I could give to Aaron, and this is the perfect question for me to shoot over to Aaron because those things are important, right, in terms of business plan credibility and also backing up some of the economic reports. But Aaron, can you talk about why feasibility reports and all third-party reports in general are important, whether the finished product has to kind of like skew towards it, or what's their value really?
Yeah, so it's been stated earlier on this webinar that job creation is tied often to construction and operations of a project. So having a third party objectively look at the business model, look at the business dynamics in the area, look at the demand drivers, and give the blessing to the reasonableness of the project, I think is very important. Historically, hospitality has been very popular in EB-5, and I think it's for that very reason. It's a mature industry. The risk of construction or understanding the costs associated with construction is a known element, and there's a lot of very successful broker and third-party companies that can kind of verify that construction development cost, and then also verify the ongoing operations. So what demand drivers are in the market? What does the population and demographics look like? Does the business model warrant the revenue projections that are being forecasted? So generally, I do think it's like every solid project should have a feasibility study. It's just the basics of supporting your business assumptions. And then in the big picture, it's like, does the deal make sense? So you as a observer or user of like a hospitality product or anything else, does it make sense? And oftentimes feasibility study can be just a good objective third party to support that.
I see. So it's not really about whether the final product skews exactly like the feasibility study. It's more like a credibility test, right? If someone is saying that my budget or my final numbers are going to be this way, it's a way to kind of like show your work, I guess you can say, for your forecast and everything else.
Yeah, that's a perfect way to say it, right? It's showing your work. It's not taking the developer's word on it, that the budget and the forecasts are reasonable. It's showing the work through an objective third party that's using quantifiable metrics to support the business model that in turn supports the job creation.
Yeah, and I think what's and we've done projects for a number of years. Sometimes USCS, it rarely ever happens now because a lot of it can be preempted. But if USCS sometimes will question your job creation forecast, it's never really the formula they're questioning, right? They're questioning whether the inputs, the numbers you're putting in make any sense. So two ways to kind of really back that up is number one, if you have a GMP contract from like a GC, right, a general contractor, then they're like, okay, well, they're going to build it for this amount. Or you have future revenues, future whatever else. A third-party feasibility report makes Aaron's work a lot easier. So for those you're wondering, that's the value of what a third-party report really brings to the table.
And doesn't the F approval, though, from USCIS further validate a lot of that data that's being entered into the metrics itself? Like, they're verifying your NAICS code multipliers and what methodology you've used and all of that. Isn't that, one of the whole, basis behind getting the F approval?
Yeah, I mean, they're gonna look at, like when it comes to job multipliers, they're gonna review the economic analysis, and the economic analysis has to include direct screenshots from the economic model that show that you're not making them up or skewing them, like they came from the model itself, right? So that's all gonna be included in there. And they're gonna review things like in an economic model, like does your region make sense? Did you try to claim jobs for the entire United States, indirect jobs, when your project is located in, Minneapolis? Or did you say, hey, I'm going to limit my region to really where most of the jobs are going to be created, which is, in the Minnesota, area, or in the, Minneapolis, St. Paul area. And so just they're going to verify those things and make sure that they clearly make sense. And once that F is approved, you do know that your multipliers are set in stone and they're not going to go back on them. I would say that. I would also add that the one thing I've always noticed in projects over the years is the third-party studies. I've always noticed that they generally get it right on the like the total revenue or the total cost projections, they tend to be pretty straight on. Where sometimes you fall short or where things happen that they can't estimate is in times like cost. And so, and the importance to this is as long as you get the total revenue right, the jobs are going to be right and they're going to be there. And they tend to be pretty good at that. Where they sometimes miss it is they can't understand that, like, well, 2 years from now, after I made this projection, the government came in and raised the minimum wage by 40% for workers, or something happened where they can't always be accurate on cost because they can't see the future on that. But they do tend to be pretty accurate on revenue projection as they're using actual data from every competing project in the area to estimate it. So it tends to be pretty close on that side.
Got it. Got it. Well, thank you, everyone. We've ran a little bit over time here. So I just kind of wanted to wrap up by first thanking all the panelists for joining us here today late in a Wednesday evening. Appreciate all your guys' time and expertise and what you all do for regional centers and EB-5 investors both. Really do appreciate it. Yeah, if anyone's looking for legal counsel, please do contact KLDP. They're very responsive, great to work with. Happy to put you guys in touch with them as well. If interested in learning more about, safe projects, some of AIIC's group projects that are I-956F approved.
Congrats to
feel free to reach
AIIC
out.
for their 956F approval. I forgot to say that. So congrats.
Yeah.
Well, thank you, Niral and Phuong. You guys worked very hard on that for us, and yes, we were very happy with the F approval, and appreciate all the hard work that you guys did in getting that through for us. Yeah, and if you just want some overall guidance on EB-5, just as a general consultation, many members of the AIIC, me included, have been doing this for multiple years. It's, I offer this out there. I don't charge for, consults just to talk and have a conversation about what the EB-5 process is like, or what the different stages are, or what to look for. Happy to, reach out to me. My email's right here, Vikram at AIICEB5.com. And thank you, everyone, for attending. And we're signing off.
Cool. Thank you, everybody.
Thank you.
Thank you.
Thank you.
Mm-hmm.